Howdy, Jacob here. Today we're looking at Barnes Group in the machinery industry. 2 billion market cap on 3.2 billion enterprise value. So we are looking at quite a bit of net debt here. They provide engineered products, industrial technologies, and solutions globally. Incorporated in 1857. They've been around for a second, that's for sure. And the growth wise, we're looking at 1 to 2% a year in growth rate, so very small. And sadly, decline in both gross and operating margin. Dividend kept the same the last couple of years, but their margins have been hit, so it's becoming more and more of a problem to be able to afford it. With return on invested capital in the mid to low single digits. Let's see what's the problem here. So sales in general is growing quite a bit. Likely due to inflation, they're going to have to pay their workers quite a bit more. And then same with cost of goods sold going up quite a bit. But their revenue and demand is really not going up. So they're likely selling their products for more, but there's less demand for the products. And then in all of their expenses, it's just costing more to keep them. And so that is a little bit of a problem. Balance sheet has 90 million cash on hand, 1.2 billion debt. But it does look like they had a larger net acquisition recently. 719 million net acquisition, went 705 million in debt for it, and we're just gonna have to really gonna have to figure out whether that was worth it or not. If you'd really want this company or that acquisition to be producing quite a bit of free cash flow, because right now you're looking at the free cash flow was almost 200 million in the mid 2010s, but recently you're looking at 50 million. I mean, just very small, very short on free cash flow. So, I mean, this is going to be an ugly analysis, but I'm going to get right to it. So on the revenue growth side, maybe 2%. And then I'm going to go 8 on the PE because I think I probably would do 10, but their enterprise value is so much greater than the market cap. I'm taking the debt into consideration. And so I think I'd want to get it extraordinarily cheap. And then for margins, they've been going down, so I'll lean on the lighter side, actually. Maybe let's do 5 and 7. And then for share change, I don't remember them buying back any shares recently. Stock-based compensation 10. Let's just, whatever, say no share change. And I mean, again, I think any investment can be good at the right price, but by golly, you're going to have to get this one extraordinarily cheap because the margins going down as fast as they are is a huge problem to me. And, their expenses are going up a lot more than the revenue. And so that's just creating a problem. This acquisition possibly was a great investment, but there's no reason to look at it to see if it was a great investment because it's not so obviously cheap that I want to look at it. But anyways, I hope you enjoy the video. Have a great rest of your day. Thank you.